Hello guys, and thank you once again for coming to this YouTube channel. And today I'm going to be talking about the truth about the Forex market. So the first thing you need to know is it's not a get rich quick scheme. You can't get rich overnight. The quicker you make your money in the Forex market, the quicker you're going to lose it, especially if you're a beginner, because you're gambling. I have met a lot of people that I've told about Forex, and they quickly say that it's gambling. It's because they've done it the wrong way. They got in the markets and they put all of their money. They probably won the first two trades but failed the next trades. It's because they did it the wrong way. So you need to have the right education and the right training in order for you to be a successful Forex trader. And Forex trading requires a lot of time, dedication. You need to sacrifice a lot of things. Your time is utmost important in the Forex market, especially when you're learning. Okay? Then people always want to get rich in 5 days, 2 days. That's going to be impossible with Forex trading. You're going to dedicate yourself a lot of time and a lot of learning. And there are a lot of mistakes that you're going to come through. And what's important for you to go through the hurdles one step at a time until you're a successful trader. Okay. And in this course, I'm going to be taking you from the basics to being able to trade for yourself and being independent. Forex has the potential to take you 5 years back, to take you 10 years back. It can wipe away all your savings. It doesn't care. It doesn't care that it's money for your kids' healthcare. It doesn't care if it's money for your rentals or if it's money that you got from your hard sweat. It's just going to take it if you don't know what you're doing. So you need the right training to be successful in this Forex market. When you start trading, at times you make money just when you get into the Forex market. At times you start on a downhill, and things that will come to your mind are either Forex is a scam or you need some help. If you need some help, some people would opt to go for signal services. Signal services are good only if you know how to use them. You need to risk properly when you're taking your signals, because someone might be good in the Forex market, but they are not 100% correct on the direction of the market. So when they tell you to buy or to sell, you need to know where the stop loss is, where the take profit is, and your stop loss is supposed to be managed that if the trade goes the other way, you don't blow your account. So with that being said, I'll just take you guys through the introduction part of what Forex is, and we'll take it from there. Okay guys, welcome to the introduction part of Forex, and I'm going to be as fast as possible on what Forex is. Okay, so if you miss something, I'll recommend you guys to come over this video a couple of times to understand the basics of Forex. This is just going to be the surface, and it's probably all you need to know. But if you feel like you have more information that you want to find out or research, you're free to do so. But this is basically the introduction, which will make sense as we go. Okay, so the first part is, what is Forex? Foreign exchange market. The foreign exchange market is where currencies are traded. An example of foreign exchange is when an American tourist is in South Africa and they want to watch a football game using the United States dollar. It will not be possible because it's not the local accepted currency. They have to exchange it at the bank at the current exchange rate. The foreign exchange shows the past and the present exchange rates of different currencies compared to one another. Okay, so they have to go and change the money at the bank and be able to pay the local currency in order to watch the football game. So that's basically foreign exchange. You have to exchange different currencies to suit a particular situation or to be able to trade in a particular environment. Okay, so in the Forex market, we'll be doing this digitally. No need to go to the bank and so forth. We'll be just using your own cell phone or your laptop or computer. Okay, number 2, currency pairs. A currency pair is a quotation of two different currencies, be it a US dollar or an Australian dollar, whatever, with the value of one currency being the quoted currency against the other. Okay,
So the first listed currency of a currency pair is called the base currency, and the second currency is called the quote currency. I have a picture to illustrate this. Here we have the EUR, which stands for euro, and USD for the United States dollar. Okay, so on euro USD, the euro is the base currency and the USD is the quote currency. So if someone clicks sell here, they are selling the euro in relation to this pair. They are selling the euro and buying the US dollar. If they click here to buy, where it says buy, they are buying the euro and selling the US dollar in relation to this pair. So euro USD is a pair. Euro is a currency, USD is a currency, but if you put them together like this, it's now euro USD, it's now a pair. So in this pair, if you click sell, you're selling the euro and buying. If you click buy, you're buying the euro. Self-explanatory. Okay, let's move forward. The Forex market is the largest and most liquid market in the financial world. This market allows for the buying and selling of currencies. The Forex market is open 24 hours a day, 5 days a week, except for holidays. Okay. All Forex trades include the simultaneous purchase of one currency and sell of another, but the currency pair itself can be thought of a single unit. I've explained this. As an instrument, it's bought or sold. So that's the euro USD for this example, it's bought or sold. That's the currency pair. Okay, then we look at what we call spread. Spread is the difference between a Forex broker sell rate and buy rate. For example, you have $1 and you want to buy the ZAR, which is the South African rand. The broker might buy your USD for 10 rand, but if another person comes in to buy that one USD, they will not sell it for 10 rand. For example, 12 rand instead of the 10 rand they bought it. This means that they are buying the ZAR at 10 rand but selling it at 12 rand, which leaves us with a spread of 2 rand. So that's spread. Okay, we move forward. We have what we call major currency pairs. What are major currency pairs? Major currency pairs are currencies that trade the most volume against the United States dollar, and these include the euro USD, the USD JPY, Japanese yen, GBP, Great British Pound versus the USD, USD CHF, AUD USD, and USD CAD. Those are the major pairs. Then we have what we call minor or exotic pairs. Some examples of crosses include crosses which are Euro GBP, GBP JPY, and Euro CHF. Exotic currency pairs include currencies of emerging markets. These pairs are not liquid and spreads are much wider. An example of an exotic currency pair is USD SGD, which is the United States dollar versus the Singapore dollar. Okay, we'll go to the third part. Who moves the market? The two main forces are supply and demand. When a currency increases its value, the demand is greater than its supply. When a currency decreases its value, its supply is greater than the demand. There's a saying, focus on what you can control. That simply means you need to focus on the strategy that I'm going to be teaching you and your actions on the market rather than who moves it. Okay, so don't worry about knowing about hedge funds or the big banks or the big boys in the market. You don't really need to know that. What you need to know is you have to focus on the strategy that I'll teach you and how to buy and how to sell. Okay, let's move forward. What is a pip? Pip, which is short term for point in percentage or point in price, represents a standardized smallest measurable unit which is used to show you how much a specific currency exchange rate has changed. Okay, most pairs have a pip in the fourth decimal place. For example, the Euro USD can move from 1.5432 to 1.5431, which is to 4 decimal places. It has moved a minus 1 pip. So that's minus 1 pip to move from 0.32 to 31. It has gone down with 1 pip. Okay. Another example is GBP AUD can move from 2.0000 to 2.0020, which is a positive 20 pips. Okay. The only difference that comes now is with the Japanese yen. Okay. Pairs with the JPY have a pip in the second decimal place. Okay. GBP JPY can move from 0.32 to 0.42, which is a positive 10 pips. And AUD JPY can move from 4.23 to 4.13, which is a negative 10 pips. Okay. Then we'll go to the fifth part, number 5. Types of charts. There are a few charts we're going to be using. We're going to be using the line and the candlestick chart. There are many types of charts, but you can follow only 2 because of the strategy that I'm going to be teaching you. The candlestick chart is the most used chart type. Below you can see the different chart types and how they look. Okay. On TradingView, which is a charting software that we're going to be using, if you go on tradingview.com, you click a link that is written charts or chart, you find Forex chart that comes up there and start charting. But for now, I'm just giving you an introduction. We'll go through how to set up your TradingView and your account. Okay, so on TradingView, if you click on this, you have a drop down for bars, candles, and so forth and so forth. Okay, so we have the chart types that we're going to be using. One is the candlestick chart, which has candlesticks. If you have a candle, you know that a candle has a wick and a body. Okay, so we have a candlestick chart and a line chart. So these are the charts that we're going to be using on this program. Okay, then number 6, candlesticks. There are 2 types of candlesticks. We have a bullish and bearish candlesticks. They are showing you information of how the price moved in a specific time period. If the candle is bullish, that means that the price after a certain period of time has moved higher. The opposite is for the bearish candle. You can change the color of this candle, but most often they are green and red, whereby green is the bullish and red is the bearish. Let's look at how they look. So this is our candle. This is a bullish candlestick. So price opened here and went down, then pushed up to the end of this wick of this line and pushed back down to close here. So the explanation of this candle, we have an open, which is right here when it opened. Then the low is the lowest point that it reached. Then the high is the highest point that it reached. Then the close is when this candlestick ended. Okay. So on a bearish candle, it means the price is going to move down. So it will open high or open higher than this one and move down and close down. So that's a bearish candle. So this is the open, this is the highest it went, this is the lowest it went, but it closed here. So the price opened here, moved up, went down and closed here. So this is a bearish candle because it closed way down than it opened. Then this one is a bullish candle because it closed way up than it opened. Okay. Number 7, we have time frames. Time frames are different, and you have major time frames like the 15 minutes, the 30 minutes, the 1 hour, the 4 hour, the daily, the weekly. You also have the monthly. Okay, let's say you have you're on the 15-minute time frame. This means that each candlestick represents 15 minutes. Okay, then if you're on a 30-minute candle, then it means you are seeing a candle that formed in 30 minutes. Okay, so if you have a 30-minute candle, it means you have 2 15-minute candles. Let's see the example below. Okay, so this is an example of 2 15-minute candles. So this candle opened here and it went up to the high and closed here. This is a green candle, so it's a bullish candle. This one opened here, didn't even go up, went down went to the low and closed here. This is a red candle, which is a bearish candle. Okay, so these are two 15-minute candles. If you combine them, they'll make a 30-minute candle, because it's 15 minutes plus 15 minutes. So it will be represented with this type of candle. It opened here, went up, and then came to close here. It's green because it's higher than its opening price. If it went down, it was going to be red because it would be lower than its opening price. Basically, you can combine these to make this candle. So it's the same thing if you go to daily, if you go to weekly, if you go to 15 minutes, if you go to 30 minutes, it's the same concept. Okay, so let's move forward. We have number 8, brokers. A broker is a person or firm who arranges transactions between a buyer and seller for a commission when the deal is executed. Trading without a broker is impossible. So the broker is the middleman, and you can't skip them. Okay, there are many online brokers right now, and you can choose between them. They are mostly all the same. They are charging different commissions and also spreads. My recommended broker is IC Markets. I've been using it ever since I've started trading, and I've never had a problem with them. Okay, I'll do another video of how to select a broker. There are B-book and A-book brokers. You have to know which one is suitable to use, the advantages and disadvantages of the type of broker you use. Okay, then we have our trading platform, which is called the MT4, which is in section 9. The MT4, also known as the MetaTrader 4, is an electronic platform that is used by traders. Okay, it's a platform that you can download on your phone or desktop. When you create your broker account, you get login credentials to your MT4 account. So when you create it on IC Markets, they'll give you the credentials to log on and set up on your phone. We'll go through this in the following videos. Okay, then the last part, equity or balance or margin. So equity is the sum of your account balance and all floating unrealized profits or losses associated with your open trades. As your current trade rise or fall in value, so does your equity. So if you have a $100 account, if you open a trade and it goes minus 10, you have 90. That's your equity. But if you haven't closed it, it can go up to plus 10 and you will have 110 as your equity. So if you open 15 trades and they have an equity of $100, then it means your balance in your account plus that $100 becomes your equity. So it's both the balance and the open trades. That's your equity. All right. So I think I've explained the basics of the introduction. We'll go in depth as we go to the next chapters. So I hope you guys understand. And if you have any questions, just hit me up in the comment section. Then we take it from there. Thank you so much.
Thank you guys so much. I hope you enjoyed the introduction part of the course, and we're going to be moving from here going forward. All the concepts that you need to understand, I'm going to explain them. So if there's anything that you haven't understood yet, give it some time, you understand it. So I hope to see you in the next video. Keep subscribed.